Um, everyone should understand that the trading the markets involves substantial risk, and a person can certainly lose a substantial amount of money. Obviously, we're looking for a substantial amount of upside, but nothing can be guaranteed. So always carefully consider your financial position. Never risk more than you can afford to lose. Now, I'm going to skip my background, and there's just a few things I want to focus in on from this slide deck. Why do we trade credit spreads? And just really quickly, it's a very forgiving strategy, and I'm going to show you why, and I'm going to use pink to do it. But let me just go to a particular now, there are two metrics that we use that I am going to show you directly right off of the thinkorswim platform, how we determine the size of the volatility that's associated with the trades that we want to take. Now, we want a very, very high implied volatility. That means that the price of the option is intrinsically very expensive. Now, when options are extremely expensive, that's when we want to sell them. We want to sell expensive options to someone else so that they're going to pay us a really juicy premium for taking those options off their hands. So we're going to pay very, very close attention to one of the metrics that should be on any options trading platform, and that is implied volatility. And I'm going to show you how by using the IV number, you can sort of predetermine whether or not that's an underlying stock that is going to be predisposed to being configured in an appropriate way that's going to provide us with a really, really nice premium when we sell the spread. So IV rank is extremely important, and you can discard an enormous amount of stocks just by looking right up front at IV rank. Now, the other is theta. Now, time decay, when we sell an option, is always on our side. And that's the problem when you buy an option. What you do is you acquire an asset that depreciates over time. So really the gun is always to your head to get that trade profitable, hit your target, and get out of the trade. Now, if you take a look at the time decay curve, theta decay really kicks in about 3 weeks prior to options expiration, then begins to accelerate geometrically as you move towards options expiration. So optimally, about 2 to 3 weeks prior, optimally 3 weeks prior to close, you want to get out of the option, because then you're fighting if you don't, you're fighting two things. You're fighting not only the underlying price of the stock, but you're also fighting the decay of the option that takes place every single day. Now, you can go to theta. That's a Greek that I don't have that appear on my platform because I sort of know what I want to get out of the trade, set targets. But you just know that when you sell a spread, you want time decay to erode the price of the spread that you sold to someone else. And that provides you with a tremendous advantage on the trade. So as time progresses, you slowly evolve into a better and better position. And I'm going to talk in this particular didactic session about stock assignment, because I'm going to show you just a recent example. I do not go into this in our normal in the normal webinar I do, but stock assignment doesn't necessarily have to be a bad thing. And in fact, I leveraged it today. It was the #1 performing stock in my portfolio. I'm going to show it to you. It's a stock I took assignment on, and I've turned a losing spread into a winner by holding on to the stock. Now we're trading about 80% profitable in the portfolio. But if you took assignment on the losers that we had, you would have no losing trades in your portfolio. So every time that the stock is assigned, and that's another thing I want to show you about picking stocks. You have to pick blue chips. You have to pick stocks that are really stellar in character, so that if you get assigned the stock and you have the money, now we're not looking for stock assignment, and you don't obviously have to take the assignment, because then you can just demand assignment on the put you own and the trade is canceled and it's a loser. But if you do accept assignment, and I'm going to show you on the platform, then you can wind up turning a losing trade into a winning trade. Now, I'm going to drop this. Let me just make sure. There's just one other slide here. The vertical width of the trade is extremely important. So there are two things that you want to do. And I'm going to show you vertical width right off of my live Thinkorswim platform. I didn't want to show it to you off a slide, and I'm not even going to bother with the metrics. But the vertical width has to do with the distance between the option that you sell and the option that you buy. And the further the distance, the more money you can potentially make on the trade, but also the greater risk. The best trades possible have a very small vertical width. I want to give you an example of that. Now, this is a trade that I took on McEwen Mining back in November of last year. Now, it was a $6, $7 spread that I sold. Now, I'm going to show you my formula just in case you're not familiar with it, because this is all cookbook. And what you take away from this presentation today, you're going to be able to apply on your own platform, do your own due diligence and your own work if you don't want me to do it for you. Now, what I did was I sold the $7 put and I bought the $6 put. Now, the $7 put is the 50 delta, and the $6 put is the 25 delta. So this gives us a vertical width of only a single dollar. And I show you that right here. Now, when you can get a vertical width of $1 and you can get a 45% net credit, then you've got yourself an absolutely stellar trade. These are the kind of trades that we're looking for. A tight vertical width with a very high implied volatility, so that you can garner a significant amount of money when you sell the spread, and the risk you take is really minimal. Now, if you can consistently take trades like this, you only need to win 55% of your trades. If you win exactly 55% of your trades, you're going to break even. If you win 65% of your trades, you're going to make a significant amount of money. 75% more, 85%, a lot more. So the vertical width of the spread you trade is I consider to be the most important component. Now, it's not the vertical width, it's the premium you get when you take the trade. So if your vertical width, say, is $5 and you can get a 45% premium on the trade, it's still a stellar trade. Now, this is why it's very forget. I know I'm plowing through a lot of information. You have the opportunity to ask questions, but this is why it's a very forgiving strategy. Now you have to obviously have some kind of directional bias when you take these trades, but you don't have to have a strong directional bias. Obviously, if you buy a call, not only does that underlying stock have to go up, but it has to go up enough to cover the price of the call that you purchased. So let's say that you paid $2 for the call. It's got to go up $2 in price and then some before you're in the money at options expiration. That's entirely different when you sell a credit spread. When you sell a credit spread and you, excuse me 1 second, let me just mute this. These are just all spam calls coming in to torture me. Now, when you sell a credit spread and you sell the $7.50 delta, the stock only has to trade at $7 or $7.01 for you to keep 100% of the premium that you got at the outset of the trade. So you're going to keep all of the $45 that you got in your portfolio if the trade closes or we close the trade with McEwen Mining trading above $7. So we don't have to trade above some number that is attributed to the cost of the trade when we took it. Now, with a 45-cent or $45 premium, McEwen Mining can trade all the way down to $6.55, and we're still going to make some amount of money. And it has to trade under $6.55 for us to be in the red. So we have an enormous downside cushion where we still are going to make money. Now, if for some reason some crazy news comes out, it happens on stocks, we have to be very, very careful about trading into earnings reports. Many months ago, about 7 to 8 months ago, we took a spread on Lockheed Martin. And that's when Lockheed Martin had a recall of a huge number of its jet engines because there was some metal powder on them. So the spread collapsed. Now, obviously, that's going to happen sometimes. I'm not going to be here to tell you that you're going to win 100% of your trades. And if I did, you should click out real fast, because every now and then news comes out that we can't anticipate. And what happened was Lockheed Martin fell through the lower edge of our spread. So it fell through what the equivalent of the $6 put and just fell all the way down. I mean, I believe we had a 460, 470 spread, and it fell all the way to 412. So we were assigned the stock. Now, as I said, I took assignment. Now, that is something you do not have to do. But once it falls below the lower edge of your vertical width, if it falls below the $6 put you bought, you have the potential for some trader out there to exercise his right to stick you with 100 shares for every spread that you created. Now, you may not have enough money in your account to cover, no big deal. You're going to exercise your right to sell 100 shares for each of the options that each of the puts that you own. So the trade is canceled, you're out, and it's a loser. But if you have enough money to take assignment, in 6 months, I had Lockheed Martin trade all the way back to 475. And I wound up making an enormous amount of money on the trade. So that's one way that you can sort of band-aid your losers. But you obviously need a significant amount of money in your portfolio, and that's not what we shoot for. But because this is a didactic session, I want you to be aware of the fact that you can be assigned a stock if it falls through the lower boundary of the put that you purchased. Now there's one question here. Hey, Chuck, if stock drops to your short strike and you're okay with assignment, you first have to sell the long strike. Well, you know what, Chuck? That's a terrific question, because let's just say, for instance, that on the $6, $7 spread, now you sold the $7. Now that is going to be the put that provides you with assignment. It's the put that you sold, but you're still left with the put that you purchased, the $6 put. So what's going to happen is, in the case of Lockheed Martin, it's a different number, but that put is going to explode in price because the underlying stock fell all the way through it, and you now have an in-the-money put with a stock that's really floundering. Now, on the trade that I'm going to show you, it's on the ticker's IBP, and I'll give you the name of it. IBP is trading up today $14.56. That's Install Building Products. Now, I'm already in the green on the trade, even though the spread failed. But what you can do, one of two things. Now, on this particular trade, what happened was the Fed decided that they were not going to cut interest rates. Now, we don't know that that's going to happen. I mean, the economy is coming in pretty hot, but they came in with an announcement all of a sudden that they're going to hold. And the anticipation that traders had was they're going to hold all through the summer, maybe into the fall, and they might even not cut interest rates all the way in 2024. I mean, the economy is roaring, and we've just had a few. Today we had Lockheed Martin report earnings. Now, we have a spread in the portfolio on Lockheed Martin. I mean, it beat top line, bottom line, and Lockheed Martin is down $1. So, I can never anticipate, but I think that ultimately it's going to draw buyers in and push Lockheed Martin up. But the bottom line is, there's information that comes out that we just can't know. So what you're going to wind up with, to answer Chuck's question, is you're going to wind up with a very, very profitable put that you purchased. Now, what I did, Chuck, was I closed the put. I sold the put I owned with a 245% profit. So all of a sudden, I have cut the amount of money I'm down on the spread. So what I've done is I'm sitting with the stock and a 245% profit on the put that I own. So obviously that makes your sort of the headwind that you have to have that stock trade back to that $7 range a lot easier. And if it does trade back to 7, you're going to be way in the green. So, and remember, it doesn't have to trade back to 7. All it has to do is trade back to $6.55. So you really have a lot going for you if you have the money to take assignment. I personally always take assignment. because I have a lot of faith in the underlying stock that I purchase. Now, traders are beginning to see that just because the Fed is not going to cut interest rates, home sales are taking a little bit of a beat, but they, the market's always a forward-looking instrument, and the Fed is going to cut interest rates. I believe that, the Fed is a very, very, it's not supposed to be, but it is a very political body. They're going to want the market to soar going into the 2024 election. Jerome Powell is a Biden appointee. He's going to want to make Biden look as good. And this is not just a Democrat thing. It's a Democrat or Republican thing. They're going to want to make their candidate look as good as possible. So if cutting interest rates going into the fall is going to catalyze the market to the upside, even if it's not necessarily overall in the market's financial best interest, Jerome Powell will knock it down 25 basis points and the market's going to fire up. So traders looking out into the future see diminished interest rates, diminished Fed rates, and IBP has just rocketed to the upside. And based on my Thinkorswim numbers, my year-to-date number on IBP has now gone from the red into the green. Now, of all the stock that I own on IBP, and let me tell you, I own the bunch load, I sold half of it today because I'm going to take my profit when I'm up 10% on the stock. Actually, I'm up 10% on the position overall, including the credit spread. So I'm 10% up. I'm sitting with one half of the stock that I was assigned. I sold the put that I own for a 245% winner. And that credit spread has matured, even though it was an initial loser on the Fed announcement to hold interest rates. It has evolved into a very, very profitable winner. So what you want to do is always have that in mind. Now, I try to pick stocks that are cheap. As somebody who's out there every day going through trades, trying to find the best, you have a lot of burden on your shoulders. Number one, you want to find a stock with a very high implied volatility. Number two, you want to try to find a stock that you're able to configure optimally with a small vertical width. And then thirdly, you want to try to trade a stock that's cheap so that if you do get assigned the stock, if you have a large, I don't like having a lot of capital tied up in a stock in my portfolio, but I know that when I take the trade, it's got to be on a stock I'm willing to hold because of the potential that something will happen out there that we can't anticipate that's going to tank our spread. Now, 80% of the time, our spreads are profitable. And if you wind up getting assigned, you can zip the trade up by demanding assignment on the other put that you've got. You're going to wait a little bit because you want to remember, if you're holding a put and your stock is sinking, you want to try to optimize your profit. But if you take assignment, it doesn't matter. If you take assignment, you're going to take your $55 loss, and it doesn't make any difference. Now you have 3 days to cover. That's a CFTC or FTC a law. You can't have a margin call. They may, even if they cite you on a margin call, you have 3 days to either add capital or cover the position. So once you get assignment, you have to make a decision. Am I going to hold the stock and sit with the put and hope that the stock trades lower? Or am I just going to exercise assignment on the put that I own and zip the trade up and take my lumps on this particular spread? That's really, really up to you. Either way, you're going to wind up trading profitably. But if you can handle assignment, I can tell you, you can trade a lot profitably, a lot more profitably. And I can tell you that on IBP, I mean, I don't want to, it really has provided me, it's up $14.09 at the close. Now, I don't think it's right for me to tell you how much stock I owned or how many spreads I traded. I never do. The one thing I do tell you is I'm in every trade with you. I believe that's important. If the trades are good enough for me to send to you, I'm always going to take them. I have a fixed amount of capital I'm going to risk on every trade. So I'm going to take assignment if I need to. Pretty much, well, that's going to vary depending upon the size of the stock. I mean, Lockheed Martin was a $420 stock that was assigned to me at around $450 or $460. But on that particular position, I only had one spread because it was a 15 wide spread, which is something I'm never going to do again. It's too wide. So let me just go through. So I don't want to go through any of the rote stuff that I do in the webinar. So the really important metrics, and we're going to look at these right on the Thinkorswim portfolio, is the direction. You have to have a mild anticipation of the direction that the trade or the underlying stock is going to go. You don't need it to make a strong bullish move. You don't need it to make a strong bearish move. In fact, the stock can move sideways in tight consolidation. You are good to go. Now, if you're new, we always sell the 50 delta. I'm going to show you that on the platform, and we buy the 25 delta. Now, you're going to hear all the time about webinars where traders are going to tell you they win 90% of their trades, 95% of your trades, but they trade deeply out of the money spreads. And I swear, no matter what you do today, do not take that strategy. It is a recipe for disaster. I saw a webinar about 2 weeks ago where where the mentor was looking to make $50 on $1,000 of risk. Now, the chances of losing the trade were small, but if you do, it's going to eat up 20 winners. You know, it's like getting 0 and double 0 in roulette. It's very unlikely to happen, but if it happens 2 rolls in a row, you're down an enormous amount of money. So trading deeply out of the money spreads is a recipe for disaster. I have done it in my past, and it cost me one of the biggest losses I have ever had in my trading career on Walt Disney. Now, there are a couple of other things that are very, very important. Obviously, when you're bullish, you're going to sell a put spread. If you're bearish, you're going to sell a call spread. Now, the expiration date is extremely important because there's something that it's called gamma whip. Now, I'll show you how this works better on the Thinkorswim platform. But remember, for each incremental change in price of the underlying stock, you really only want your spread to change a small amount. You've got time decay on your side. If you're mildly bullish, you just need that stock to move up a nickel, really only a penny. If you're mildly bearish, you need it to move down a penny. So you really don't want the underlying stock to affect the value of your spread very much. But as you go into options expiration, gamma begins to increase exponentially, and a small change in the underlying stock price leads to a dramatic change in your credit spread. Now, 2 weeks before, I'm gonna give you the truth. We had 5 open positions. 2 weeks into options expiration, all 5 of those trades were trading in the green. 2 of the 5 were up 90%. 3 of the 5, one was up about 50%, and the other 2 were up between 20 and 30%. Now, I didn't follow my own rule. And when I break my own rule, it always causes a catastrophe. 14 days into expiration, you must close the trade. Because if the market takes some kind of unforeseen dip and you're bullish, or it just trades up for no special reason, it's going to destroy your credit spread value. So you're going to avoid this happening if you close the spread 14 days prior to expiration and optimally take a spread with an expiration of 42 days. Now those are just optimal numbers that I've come across after trading for over 20 years on this one strategy. So you're looking for a 42-day expiration that you're going to close in 28 days. Now, just to end the story, I turned 3 of those 5 trades into losers. Now, one of the loser was IBP that I just showed you, that by taking assignment, I turned into a very big winner. I think IBP has legs. I think it's going to go up another 10 or 15 bucks. I still have half of my stock, and I'm still going to walk away with a lot of money. But I threw away 5 solid winners and only took 2 of the 5. Wound up taking assignment on 1 and turning it into a winner. And this is what I recommend everybody do in the service. But we're not there to take assignment. We're there to get profitable credit spreads. So it's not a mandate, and I don't follow that. Like, if you take it, you're on your own. I mean, you know what you're doing if you take assignment. I book the trade as a loser because I make the assumption that everyone does not have the money in their account to take assignment. So we have 2 mandates. 14 days prior to the expiration of the spread, we must close it. Even if it's a partial loser, take the small loss and take it off the table. If it's a partial winner, 20, 25% of your potential net credit, take it off the table. And don't let gamma whip snap your trade from a winner into a loser. And really, I could knock myself upside my head for 5 winners, bang, 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 letting them go. Now, it just happened to be that options expiration was on a Friday. And obviously, that's when that 14-day date hit. All 5 of those trades should have been closed on that Friday, when we would have walked away with 5 winners. So based on my bad advice, a lot of people held. And I'm just telling you right up front, I'm not perfect, but it cost me 2, but I was able to resurrect 1 trade by taking assignment. Now, the premium width is critical. If you have, it's really the premium percentage. You want a 40 to 45% premium percentage. So that if you can get a premium percentage of 45%, for every $45 of potential reward, you risk $55. That is outstanding on a credit spread when you take into consideration the fact that the underlying stock only has to move 1 penny in your direction from the date you take the trade to the date you close it. And you want to have a stock that has a very high IV rank. That's critical. You have time decay in your favor, and you want to take a trade that is exceedingly, where the underlying option is exceedingly expensive. Now, just to go over my formula, You take a trade that has a 45-day to expiration. If you're bullish, you're going to sell the 50 put delta put. You're going to buy the 25 delta put. If you're bearish, you're going to sell the 50 delta call, buy the 25 delta call. You're going to do that over and over and over and over. So this is not a complex strategy. And I'll show you why. I'll show you the periods of time. It's really easy to ascertain when selling options are going to be the best way to go. Now I'm going to drop the slides for a second. I'm going to move over. I'm going to move my platform up. Now let's take a look at the VIX. Now here's the VIX. Now the VIX has dropped. Let me compress this. From 19 all the way down to 15. Now, what does the VIX tell us? The VIX is a measure of fear. And what it does is it looks at the number of traders that are purchasing puts to cover their stock positions. So when the VIX spikes, you know that traders are genuinely scared that the market is going to tank. And fear engenders high volatility. So you can just take a look at the VIX and get a general feeling for whether the market has priced the options as exceedingly expensive or exceedingly cheap. Now, this is just a generality. You can always find very expensive options, and you can always find a very cheap ones. But as a huge basket of about 19,000 stocks, when the VIX is around 20, in general, the options are going to be very expensive. And when the VIX trades under 13, which it did for a very, very long time, in general, your options are going to be fairly cheap. Now it's trading around 15. So, we're kind of like in a, under 13, very cheap. Approaching, whoops, excuse me there. Under 13, in general, you're going to be facing a market that has a lot of cheap options, and that's when you want to be an options buyer. So let's take a look at some of the options that we've got out there. I'm going to take them right off of my let's take a look at VEEV. Now that is it's Viva Systems. I'm not going to go much into it's a tech stock. We're going to take a look at it. Now, I mean, this is essentially what I do. I mean, I look at stocks that I believe I know the direction they're going to take. And you can see Viva looks pretty bearish to me. Look at all three of these lines all four of these lines underneath. I'm really not going to go into how the platform functions, but you can see that Viva has taken a little bit of a beating. Now, Viva had a little bit of a pop today, but in general, it's looking pretty bearish. And what we're going to do is we're going to go to trade, and we're going to close it up. And we're going to look at the spread that is bet. Now, I don't like to trade weeklies because there's usually not a lot of volume, and you don't want to trade a spread on any options chain that doesn't have good volume. The thing that's very annoying about it is what's difficult is it's hard to get in, it's hard to get out, but also in the course of holding the spread, the market makers are not quite sure where the midpoint is. So you're going to find that the spread is going to go in your direction, and they shift the midpoint, and it's very aggravating when you open up your Thinkorswim platform, and it shows that even though the underlying stock has gone in your direction, the market make you shift the midpoint, and you've lost money on the position. You know it's just an illusion, but you just don't want to trade illiquid positions. It's a very, very rough thing to do. Like I said, the market will not let you in very easily and not let you out. So you don't want to do it. So we're stuck right now because we're going to either have to take a spread that's 59 days out, which is a little bit longer than we would like, or 24 days out, which is a little bit shorter. Now, what I tend to do when I'm caught in the middle like this is take the spread that's a little bit longer, rather than go to the spread that's a little bit shorter. Now, we know we have a bearish anticipation on the trade. Now, the key is we want to look at the implied volatility at the 50 delta price. So let's look at the 50 delta. Here's our delta, and we want to, now the best we could get here is a 57 delta. And you do have to be a little bit conservative, you have to be a little bit flexible. Optimally, we want a 50 delta, but sometimes we're just not going to get it. So we can either trade a 42 delta, which is slightly out of the money. That is going to be a 210, and it's actually it's trading at 201 right now. So I don't know. So these numbers are really quite a bit. We really want to look at the 200 delta. So we're going to look at the 57 delta because that really is the at the money. So what we're going to do is we're going to take the spread and we're going to sell the 50 delta call. This is a bearish. Now look at the implied volatility. It's only 33%. That tells you right off the bat that this is very unlikely going to give us a really advantageous credit spread premium. Tells you right up front. I'm going to go through it, but you're going to see you want an implied volatility closer to 90 to 100%. You want a high IV percentage or IV rank. So this is obviously not going to be the kind of spread that we're looking at. Even though it's tech, there's just no intrinsic volatility priced into the option spread. So we're going to sell the 50, and then we're going to hit control, and we're going to buy the 25 delta. Now the best we can do is a 28. I'm going to go right here. And you can see on a $20 wide, we're going to get about $8 of premium. Now that really isn't half bad. Let me use my calculator because that's a 40% net credit. That is not a bad net credit, despite the fact that we've got low implied volatility. Now you could see how great it would have been if that implied volatility was closer to 70, 80, or 90%. That's where you're really gonna bank it. Now, if we were to take this trade, what I would do is I would move this up to $88 and set a limit so that I would only execute the trade if the market was going to give me $8 of credit. That would give us a 40% width, but this is a 20 wide. So for every $8 of credit that you could potentially get, you're going to risk $12. So it's at 800 of profit, 1,200 of risk. So this is obviously a spread where you're probably only going to want to trade one spread. I mean, in general, I think it's a great idea if you can to proportion $1,000 per trade, $500 per trade. The amount is really up to you, but $1,000 will allow you to take almost every trade I call. Now, this is not a trade I would take because if I'm going to trade a tech stock, I'm going to look for a lot better than $8. Now, one of the reasons we only get 8 and the implied volatility is low is because we're out 59 days. And when the further out you go, the lower the market will price implied volatility. So now we're going to have this problem with every position that we look at because we're stuck sort of in no man's land right here. So we're going to delete this trade and we're going to find another underlying stock. And let's look at something else. Now, I'm telling you, there are tons of scanners out there. I have a scanner, which I can show to you that builds trades based on IV rank, but I'm telling you, it doesn't provide you with optimal trades. I don't want to waste your time trying to find, trying to trade off of scanners. A scanner on a fixed algorithm is simply not going to give you what you want on a trade. So let's take a look at synopsis. And let's go to the chart. It's very important to look at the technicals. SNPS. Now, synopsis is rough because it's caught between the 15 and the 50. And we've got differing colors down here. So in terms of directional bias, this is a tough trade to call. Now, these are 5-minute candles. So, and that's what I like to trade. So this just on a technical basis doesn't provide us with a nice setup. We've got downside support right here, and we've got upside resistance. So we're going to pass on synopsis. Now, I tried to get into the NVIDIA 2 times. It's NVD, but I couldn't get it. It ran away from me. But we can take a look at NVIDIA. NVDA. Now, these are expensive stocks, obviously. Now, NVIDIA is not in a bad spot. We don't have the metrics below price that really provide us with a bullish setup here. And it's trading below the 15. So again, this is a trade I just wouldn't take based on the technicals. And the technicals on the trade, you see this box? This is a consolidation box. And NVIDIA's popped out of that box to the downside. The system provides you with a downside signal when you get we call it a pop out of the box to the downside. When consolidation breaks in the bearish direction. We've got support. This is the VWAP. We've got support all the way down here, 815. It's not very far in NVIDIA. So technically, another trade I wouldn't take. Let me go to another one. And unfortunately, this is what you have to do, is go through these trades one by one. And I'll show you one that I know is going to give us a great technical setup. It's just going to be a matter of whether we want to take it. And that is Wolf. W-U-L-F. Now, Wolf on a 5-minute is really also not trading that well. It's right below the zone of consolidation and not an optimal trade. This is why it's a laborious task to find trades that are really going to be advantageous for us. Let's go to Coin. Again, it's trading below this zone of consolidation. Now it's coming up into it, and it may evolve into a long trade. And this is what we're going to have to look at closely, because Coin, I would imagine, is going to give us a great implied volatility, but boy, its average true range is immensely large. Let me keep going on my list here. Now, this is a healthcare stock, and I don't think we're going to get great implied volatility here, but let's look at Healthcare of America. See, now here's your perfect technical trade. You can see it is popped out of the box to the upside, and it is running. Now we have this on our options portfolio. This is in the regular options. We have a bull call spread on it, and today HCA was up $9.75, which is a really, really nice move. So let's take a look at HCA on the underlying, on the trade. And let's go to the to trade. Now, again, we're stuck with that 59, but on a healthcare, let's take a look at the 24 days out. That means we only have 2 weeks to hold this position because we must close it 14 days into expiration. Now all of a sudden, IV rank has jumped up a lot. You can see implied volatility is a lot higher because we're taking a much shorter dated spread. So let's look at the 50 delta. Now we're going to take a bullish trade here. So we're going to look on the put side. So we're going to look at the 50 delta right here. Implied volatility is it's 35%, but we're going to configure the trade. It's trading at 319, so the 320 is perfect. We're going to sell the 320 put, and we're going to buy the 23 delta. Now this is a 20 wide with a $6.80 credit. No good. It's just not enough. The risk to reward here is too high. So it's a very, very laborious task to find optimal trades. Let me tell you what I'm looking at right now as potential trades. One of them is 4. Now 4 is a payment processor. Now, in no portfolio do I hold this position. Now let me delete this. And let me look at the chart. Now 4 here, not a good setup long. Unfortunately, this is a pop out of the box to the downside, and we're not going to take it. Obviously, it's not a good trade. Sure, actually, it's broken the 50. I'm not going to scroll the chart to look for the 200, but we're not going to take that trade. Let's look at PayPal. And I just want you to know one thing. There's no shortcut because there is no scanner that's going to hand you these trades. Now, PayPal is a potential because it's just about to break out of the box right here. It's threatening to do so. So let's just take a look at it. Let's take a look at the trade. Unfortunately, we're stuck. We'll go with the 24. And let's take a look. We're going to be bullish on the trade. So we're going to look at the 50 deltas. It's trading at 64. So we're going to look at the 48 delta, which we're going to sell. And then we're going to buy. We can buy the 26 or the 23. Let's go with the 26. I will go with the 23. And we're going to, I'm sorry, did I buy that? I sold it. Let's buy the 23. And that gives us on a 6 wide, $2.31. Bad trade. It's only about 33% of our net, of our vertical width. So you can see how hard it is to find optimal trades. It is not easy. It takes an enormous amount of time, an enormous amount of work. Let me look at a couple that I think are going to do it for us on my hit list here. And what you have to do is you have to create a hit list. I have 300 stocks in my hit list, and I really have to scroll through them every single day. Let's look at VERT. This is a tech stock, and I think we're going to get a very high. It's VRT. I think we're going to get a very high implied volatility here. Now, this is high. Now we're looking at 79%, 80%. Before we were looking at 30%. So let's look at the 50 delta. And the 50 delta, where's my delta here? It's right here. It's trading it right at 80. So we want about an 80 delta or an 80 strike. So what we're going to do is we're going to sell, but we're going to be bullish on it. We're going to go to the put side. So we're going to sell the 80 put, and we're going to buy the 25 delta. We've got a one right here. Now we got $4 on a 9 wide, and let me calculate that out, since I'm really bad with math. So that's a 44% vertical width. That's a good trade. If we believe that VERT it's VERTEV is the stock, is going to make any kind of a bullish move, maintain, move up to 80, which is real easy for VERTEV. Then we're going to get to keep. Now I would set this at $4 because it's going to give us that. And we're going to look for $4 of credit on a $9 wide. And that's a good trade because we're going to get close to 45% of the vertical width on that. And that's a really, really advantageous trade. The most important thing is that we are going to have to be sure that the underlying stock is going to move in our direction. Now, here's how VERTEV looks. It's a little tough, but it really hasn't popped out of the box to the downside. And we're looking at 5-minute candles. Everything is either green or yellow below. This is a stock that's still supported by that zone of consolidation. So this is a potential trade. So this is really the nuts and bolts of how you do it. And I'm telling you, no matter what you might be told, there is no shortcut to this. You have to go through this trade by trade by trade. It's a very, very time-consuming and laborious task. And there is no shortcut. If you want, I can show you the scanner real quickly. Let me just go to it, and I'm going to show it to you. I'm really what I'm going to. It's the best scanner I've ever seen, and I'm going to show you how bad it is. Hang on one sec. Let me bring it up. And I see there are other questions, but I'll answer them. Hold on one second here. But let me tell you, this is no different than really configuring any good options trade. You have to look at stock by stock by stock. You have to make sure that the option you trade is cheap. You have to look at the metrics between buying a call and buying a call spread. I mean, you really have to sit and you have to do a careful analysis. Do you want to buy the call or do you want to buy the spread? I like to buy calls, but right now the market's got very expensive stocks, and in general, it's really tough to find cheapies. Now let me go to the scanner here if I can find it. Okay. Hold on one second. I'm trying to find it. The reason it's a little hard for me to find is I just don't use it. But let me take a look. Let me take a look at it. Let me try to find it here. Okay, I just can't. Because I just don't use it. So it's just not really particularly relevant to me. So I'm just going to have to dunk that because I just don't know exactly where it is. So let me answer any other question that there are. Now, I hope that you understand the nuts and bolts of the system. You know why we sell options when they're very expensive. We have a directional bias. We're going to get a very juicy net credit. We know we want to sell a 42-day out optimally, unless we're caught in between, options expiration, and we can't get an optimal. I would not trade a weekly. You want to get a vertical width above 40%. This way, if you do, you only have to win 60% of your trades. If you win 80% like we do, you're going to make really good money. You have to close 14 days out, and you have to do a stock by stock march through. You have to develop a 300, 250 long stock hit list. I have it on my phone app. I sit at night and I go through it, and I sort of maneuver it around so that when I get up in the morning, I can put them in Thinkorswim and see what kind of net credit I'm going to receive, and come up with the best options trades I can. Right now, direction is a little bit rugged on a 5-minute, and we don't want. I mean, we can go to a different time frame, and it might be easier to trade. But all I really wanted to do was show you the principles. The technicals have to align with the fundamentals. Be careful of trading into earnings reports. They are, even when everyone is telling you there's an anticipated earnings beat, the market may not like the beat. Maybe the top line beats, but the bottom line doesn't. And the market, is very fickle. Don't trade into earnings. But here's what is really good. Well, we can't leverage it. There's a different kind of trade that you trade into earnings. It's a non-directional trade. We have a directional trade. So, I mean, we're anticipating that the trade's going to move in our direction. The nice thing is it doesn't have to. We've got a tremendous cushion to the opposite side, and it only has to move a penny in our direction. So let me go through the questions because they're getting long here. I wish I could give you some magic formula that provides you with these trades, some kind of magic scanner that pops these trades up for you, but there just isn't any, because there's nothing that's going to combine the technicals on the trade with the analysis of implied volatility and the options expiration date and all of those things together. It's just not going to happen. You can get a scanner that ranks stocks by IV rank, but I'll tell you that's the kind of scanner that I have, but it is really not helpful. And all it's going to do is add work to you, and you're going to wind up looking at stocks that you don't want to take. Okay, Charles, let me see. Yes, the clip. Remember, Richard, I didn't look at open interest and volume, but on every option, obviously, that is another parameter that we have to do. This is why finding trades is not that simple. We always have to look at open interest. Now, where is my open interest here? Here it is, open interest. And we have to look at the spread on the bid and ask of the trade. That is, let me tell you, the spread tells you more about the option than I believe even open interest does. And what you perceive as the volume of the, the amount of options traded on a given day. So let's say we take a look at this option right here. See, I don't think we have, let's see, I don't think we have volume on it here. This is the stock. I'm trying to, but let me tell you what's a much better metric anyway to look at. And that is the width between the bid and the ask. Now here we're looking at the natural and the midpoint. What we want to look at is the bid and the ask. And for that, I use my TD Ameritrade app, since it's a little bit easier. But the difference between the bid and the ask on every individual option that we trade is really the key. When there's a nickel or a dime or 15 cents, say on a $4 or $5 option, and it's got a very tight bid-ask spread, you know it's got good volume. And implied open interest is important, but that's the key, is a tight bid-ask spread. And that's what I'm very, very cognizant of when I take the trades. Now, right here is where we get the bid-ask. So 95 by 110, that's pretty tight. We've got 362 open interest. Obviously, the open interest right here, look at the open interest at 80. Now, 80 is the at the money, our 50 delta. You know, 8,526 traders sitting with open positions at this area. And if we click on it, and the difference between the bid and ask is 30 cents on a $6 and a 30 cent by 60 cent spread. So this has good, this has good action, and that's a trade that we're going to be able to take. Now the 25 delta is never going to have that great a metric, but it's okay as long as your 50 delta does, because the linchpin of the trade, 2 of the 3 legs of the trade, rely on the put you sell or the call you sell, not on the call you buy or the put you buy. Now, if the market, what you're going to find is if the trade collapses and the put that you own, which is the 25 delta, becomes in play, open interest and volume is going to skyrocket on the position. And it's all of a sudden going to become a super liquid position. But at the time you take the trade, a 25 delta is not going to be particularly liquid, but that's all right as long as your 50 delta is. Now, let's take a trade that's deeply out of the money. Let's take a delta with a, let's take a, let me delete this and I'll just show you real quickly, because this is what is proffered very, very commonly. Let's take a 10 delta. Well, we'll take a 12. Now, 65 would be where this trade has to trade down to in order to lose. Now, we're gonna sell the 95, we're bullish. At the essentially a $10 essentially at a delta of 10. That means there's only 1 in 10 chance that price is going to trade down to 65 on this trade. And then we're going to buy a delta that's even higher, because that's what we need to cover the trade. And let's just say that we decide to buy the 55. Now you're going to get $1.25 on a $10 wide. So you look to make about $1 and risk about $9. Now on trades like that, this is what I see an enormous number of people proffering to sell you. You get to keep $1.25 on risking $875. Now, it's very likely to be successful, but when it's not successful, it's going to destroy your portfolio value. So you want to stay away from deeply out of the money spreads. I have had my run with them, and they are extremely dangerous. And when they go against you, they annihilate you. So as soon as you hear a $50 reward on $1,000 of risk, run from that formula, run from that trading setup. Okay. You mentioned the trade should close 14 days. But what about, well, listen, Chuck, if they're touting a 5-day or 0 weekly option, listen, the risk is always commensurate with the reward. They're looking for spreads that could potentially pay you an enormous amount of money on an enormous amount of risk. So you can certainly take them, and I'll show you one. Let's see, April 26th, it's 3 days. Let's stick with our formula. And you're gonna see. We're gonna go bullish on Vertiv, and we're gonna go with the 50 delta, which is the 80, and we're gonna sell it. And we're gonna buy the 25 delta, which is right here. So we're gonna get 310 on a 7 wide. That's a decent amount of money. But the problem is gamma. Gamma is going to kill you on this trade. If the underlying stock just moves a little bit against you, this trade is going to explode in your face. So, and what we're talking about is, let's say something happens to Vertiv that we don't know about. For one, Vertiv's earnings are coming up. The other thing, let's just say there's some kind of announcement. Now, if we have time, we can step in and make adjustments. But on this trade, this is sort of a kamikaze trade. It's either going to work or it's not going to work. If Vertiv moves to 80 and stays above it, you're going to get a really nice amount of money, but you're taking a tremendous amount of risk on a short dated spread. I'm not saying you can't do it. Just understand that if Vertiv makes a $1 move down, now you've still got $3.10 a cushion. So Vertiv would have to come down from about 80 to $76.90 for the trade to blow up. But let me tell you, this is a very volatile stock, and it really can blow up in your face. So you have to be very, very careful with the short dated. I'm not saying you can't do them, I'm just saying, understand the commensurate risk. That's all. If the underlying makes a big move, it's going to blow the option up. But it's a listen, it's a good point, and I'm glad you brought it up. Hey, Dennis. Open interest, Dennis, it's nice to trade an option that has nice open interest because you know that a lot of traders are sitting there. But open interest is generally forms sort of a parabolic curve that sort of moves right around the 50 delta. So it forms that and down like this with the two tails. So in general, you're going to have open interest right around that 50 delta price. So open interest is important because it tells you that you're not trading in a liquid position. But what is more important is the difference between the bid and the ask. See right here on this particular spread, this is 30 cents on a $1.60 by $1.90 spread. This is not great volume on this position. I mean, 30 cents on a trade that's this cheap is a pretty big spread. So it doesn't have a lot of volume, and you can understand why. It's very short dated. I mean, first of all, it's a put, and the option is, and the underlying is definitely in a bullish mode. So there are going to be fewer traders trading puts. But even on the call side, it's even worse on the call side. If we look at the 73, it's 710 by 840. That is one monster spread. So we know that volume on this position is really bad, and we would stay away from it. So open interest is important. Here's the big open interest right here. And you can see the bid and ask is better, but it's still quite high. You would want to see like a 690 by 720, optimally a 7 by 720. I would take a 690 by 720 trade, but a 660 by 720 is too big. And it just tells you that there's poor volume on the trade. That's the most important metric to look at. It's the same thing as a stock. Try trading a penny stock and look at the difference between the bid and the ask. They're enormous. I mean, to get in at one price and get out at another, you can be up 8 or 9% on the trade. And in order to get out, you got to give up that 8 or 9%. So when something is thinly traded, you're going to get a very wide difference between the bid and the ask. Okay, Dennis? How do we get your charts with it? Now the charts win if you're interested. Yeah, you call Rory, and Rory will set you up with the charts. Let me tell you something. These, and I'm not here to sell anything, including our software. Our software is absolutely stellar. I'm not going to go into it because it's an hour-long presentation, but I'm telling you, it gives you the best handle on a directional trade out there. And all of these values look out into the future because they're based on a multi-time frame analysis. So they don't tell you what price has done. They tell you what price is likely to do moving out into the future. They have tremendous future predictive value. And that's the linchpin of a successful indicator. I mean, all this stuff that accumulates data from your trading chart is useless. Now, this box is really extremely valuable because it's a zone of consolidation, and a break of consolidation usually means a nice move up. And you'd have to call Rory at 786-732-4656. Hey, Dennis. So that 80 strike, 8,500 open interest, does that mean it's unlikely to go to that strike? No, the 80 strike was the at the money, Dennis. It's already at that price. In other words, if we go back right here, and we look at the 80, and let me take this out just to take off all these numbers. And the stock is trading at $79.17. That's where it closed at, up $3.10. And you see the bid and the ask of the stock is $80 by $80.20. Look at the volume, 7.3 million shares traded. But if we look at the 80 delta here, we've got a huge amount right here of open interest. And look at the spread, 390 by 420. That's a very nice price. 30 cents, about 5 to 10% is about what you're looking for max. You'd like to get 5%, but if the bid-ask spread is 10%, I would take it. And the thing that I always do, this is just me, is I always take the trade at the midpoint. So I'm going to take the trade at 410. I'm going to make the market give me what I want. I'm not getting, I mean, that's just one of my philosophies is I don't allow the market to dictate the price I take a trade. It has to come to the price I want. So I always look for the midpoint or slightly below the midpoint to take the trade. So we know what the midpoint is right here. It's telling us right down here, it's 410. So that's where I'm going to take this trade if I just traded this call. And it's a liquid call with a lot of open interest. And if you wanted to take this call, I mean, it's very expensive. This is a much better trade to sell, but it is not overly expensive. Look at the implied volatility on the put side, 168%. This is the kind of implied volatility we want. Tremendous IV. Now, this is not something you're going to master overnight. It takes time, and if you want to trade it, you've got to spend time paper trading it, and you've got to develop the rigor to close these trades up 14 days out. If you hold, I always have traders send me emails. Why did you close the trade? You left money on the table. You left money on the table. You left money on the table. Well, the fact of the matter is, if we have one bad market day, all that money on the table would have turned to red. So it's always better to trade conservatively and zip these up 14 days into options expiration. Trust me, from almost 20 years of doing these, going back to 1997, when you couldn't do these by computer, you had to do them on the phone. I had to call TD Waterhouse, which is what it was back in 1997 before it was purchased and became TD Ameritrade. It was Toronto Dominion. No problem, Dennis. Hey, Brad, how do you monitor the spreads? You monitor the spreads right I monitor them on my thinkorswim portfolio, on my thinkorswim app on my phone. Every day, I get a real-time assessment of the percentage I'm up or the percentage I'm down. So these are very easy to monitor. You can also monitor them right off of your major platform. I'm so used to trading off my phone app because the phone app gives you really almost all the configurability of the desktop, and I'm really just wed to that phone app. I just really love it. And every day I can tell exactly how much I'm up or down on the position. Easy to monitor, Brad. Hey, Dennis. Well, I would like a nickel spread, Dennis. I'll take a dime. Listen, the smaller spread I can get, the better. But remember, I'm not settling for the spread anyway. I'm going to take the trade at the midpoint anyway, irrespective of what the market tells me. I'm not going to buy at the ask and sell at the bid. I can tell you that. I'm going to look for a trade in and out at the midpoint. That's what I've been doing. And in general, the market will give it to you if you just have a little bit of patience. Sometimes we sit in a trade for 2 or 3 days, you know, tapping our toes. Once in a while, like the trade I took in NVIDIA, it ran away from me because I would not take the trade at the ask, and NVIDIA never looked back. This is just a trade I placed, I think it was on Sunday night. I sent that trade out. Now it wasn't the stock NVIDIA, it was the ticker. It was a much cheaper ticker, which I think I like a lot better than trading NVIDIA because it's cheaper. And I'll tell you what it is. And it's one you should know because it's a really great way to leverage NVIDIA without having to deal with the with that tremendous price. But it is 2 times NVIDIA. It's a leveraged ETF, and I'll tell you the ticker. It is hang on, let me get to it. I have a whole list of iShares and spiders I always look at, because I always like to do a sector analysis and see what's bullish and what's bearish. Stay with stocks in the most bullish sectors or short the stocks in the most bearish sectors. It's Nancy, Victor, David, Larry, NVDL. It's Granite Shares 2X long NVDA. And I tried to get in. Today it was up 9%. NVIDIA was up 4%, up 35 bucks. And NVDL was up almost 9%, 8.94%. But I wanted the midpoint. It wouldn't give it to me, and the position ran away. So it happens once in a while, but so what? I would rather let a winner run than step into a loser. That's sort of my my general strategy. Hey, Gopi, thanks for sharing the trade setup. What are some ways to manage the trade as it goes against us? Gopi, as it goes against us, you can roll the trade forward. It's really the only way. It's a little bit costly to move it forward, but you can do it. I tend to not do it. And the reason is there's 2 ways to band-aid this trade. One way is to roll it forward as long as you're sure eventually you're going to get a turnaround. And usually when we lose a trade, it's on unanticipated news. And I can go through our losses. They really are few and far between, except for the couple that I didn't close in an appropriate way. There's stuff like Lockheed Martin had news that came out and just blew the trade to pieces. Now, there's no way to band-aid that, but the best way to do that is just take assignment if you can handle it. If you can't, you've got a loser. But because we have such a great vertical width, your loss is not going to be huge. And all you need is a couple of winners to make it up. Now, NVIDIA is rare. It's the only 15 wide spread I've ever taken, and I will never, Lockheed Martin, I will never take another one again. It's too wide. And although you can make a lot of money, I took a couple of 20 wides actually that are out there right now. They're too wide. No problem, Dennis. 5% of what we're looking for is, if you look at the price of the option, let's say it's $3.90. The difference between the bid and the ask here is 30 cents. So if you divide 30 by $3.90, you're going to come up with a very, very small number, about 7 or 8%. So if the bid-ask spread is 7 to 8% of the option you're trading, then you have good volume on that option itself. It's when the option gets really thinly traded, the bid and ask, look at the bid ask here. It's 20 cents by 80 cents because no one's trading it. And here you've got open interest of $7.99 and boom, it's 20 cents by 25 cents. So all you have to do is look at the difference between the bid and the ask, and it tells you pretty much everything you need to know. It tells you how fast volume is turning, and volume is going to be directly proportional to open interest. And when open interest is big and volume's big, your bid-ask spread is going to be very, very narrow. And you only want a nickel on a spread this small. And again, I would take it at the midpoint if they allow us to. Every now and then you can only take it in nickel increments, but I would put it in at about 22 or 23 cents and try to nudge my way right into the middle here. I don't like to enter a trade down. So if you enter a trade right at the midpoint, you're really, really right about break even. Okay, what's a good number when putting on spreads is a good IV? Let me tell you, upwards of 75%, Dennis. When you're looking here at IV of a 100, 170, 200, that's incredible. And that's the kind of trades you want to take. But unfortunately, I believe it's earnings on Vertev that are creating this, and we don't want to trade into earnings. But in general, you want to look at about 75% or better. When you start looking at stocks that are 20 and 30% IV rank, when you go to configure the trade, you're going to find that the vertical width is not good. So it's sort of a hint to tell you, skip it. Don't waste your time on it because there's no implied volatility priced into the option. Here, there's tremendous implied volatility. Why would you ever want to buy an option that has implied volatility priced in here at 143%? You're paying an incredible amount of money for this position. These are the options you sell to someone who doesn't know what they're doing. Let them have it at this incredibly high price. You don't buy it, sell it to someone else, and take the $2 on the trade and sit with it. Now, obviously, we don't sell naked calls or naked puts, so we have to sell a spread. But our linchpin trade is the 50 delta put we sell for a bullish position, call we sell for a bearish position. The 25 delta is really sort of our floor. And within that width, that's where we risk assignment. If it falls significantly below our 25 delta, we got trouble. But like I said, assignment is no big deal because you can close up the trade, and the worst possible scenario is your maximum loss. Can't lose more than that. And today I really raked it in on IBP, and I'm going to hold IBP for probably another 2 or 3 months, maybe 6 months, because I can handle it. And they're going to start dropping interest rates, and home builders like Toll, which I also own, IBP, which does all the products for inside the home. These stocks are going to soar, and markets for forward-looking tool. And I'll tell you, Jerome Powell's going to cut, and he's going to do it for political reasons. Listen, that's my take. I mean, I don't have any inside info, but I don't think he should cut, but I think he will. That's correct. That's exactly right. That's 5 cents, Dennis. But really what you're looking for is about 5 to 7% of the price of the option being the width. So if we take a look right here at the 275 by 320, that's a 45-cent width right here. So 45 cents. Let me go to my calculator since I can't. And we'll just take the midpoint. That's a 15% width on the bid-ask spread. And I wouldn't take that trade. it's telling you it's too illiquid. No matter what the metrics are here, it's not crossing enough contracts right now. That is the most important number. If there's a lot of traders sitting in there, so what? They might have gotten in when this bid-ask spread was a lot tighter. We want to get in when it's much tighter than that. You don't want to pay more than 5, maximum 8 to 9%. And anyway, you're going to take the trade at the midpoint, not at the bid or at the ask anyway. And if the market won't give you the midpoint, then they can take a hike, because we use our rules to govern our trades, not the market's rules. Remember, the market is built for the small, for the big money trader, not for us. So we have to demand stuff from the market, and if the market won't give it to us, let the trade go. I missed out on a big winner by demanding the midpoint on the 3X NVIDIA. But do I fret over it? No, because I got into a whole bunch of winners, and I'm never going to get every trade, but it's going to protect me. I can tell you from walking into losers. Hey, Brad, NVDL, thanks. I found it. I really appreciate it. Is gamma risk on selling weeklies hurtful to the seller? It's hurtful to us, Chuck. It's hurtful to us as the seller, and it's hurtful to the buyer. Here's the thing about gamma whip. It makes a tremendous change in the value of the option with a small change in the underlying price of the stock. Now, it could go against us or for us, and it could go against us or for us for the person we sold the spread to. Either way, both ends are taking a big risk when you trade a weekly, because if that underlying stock makes a tiny move, the value of that spread is really going to get a shot in the arm. And really, our number one mandate as traders, I know this is going a long time, is not, our number one mandate is not to make money. Our number one mandate is not to lose money. And the way you do that is by mitigating risk. So if you want to take, listen, there's nothing wrong, Chuck. If you have the predisposition and you have the risk tolerance, you can take a risky trade. Your reward can be, it's limited on a spread, but you can take a weekly call position and potentially get a 600% winner. But your risk is huge. That's all. You're never going to get a 3, 4, 5, 600% winner without taking an enormous amount of risk. And it sits on both sides. So it doesn't matter whether you're the buyer or you're the seller. Hey, Barney, we didn't get a trade this Sunday. Barney, I'm still looking. Let me tell you, it's very hard right now. I mean, taking a trade right now in this solid up market is very difficult. I took 4, 5 trades in the regular options portfolio, and I believe 3 of those trades were just left sitting. So it's very difficult. I am looking every night to get you guys a trade. Believe me, I want you in. And listen, I'm protecting my own money too, because I take every trade that I recommend. I want to get you a great trade. And as soon as I see it, you will get it. Hey, Gopi, no, my pleasure. Hey, Chuck, is 50 delta is optimal on short for credit spreads? What would be optimal delta for doing cash secured puts? I like the 25 delta, Chuck, on a cash secured, okay? I mean, that's just my predisposition. For covered calls and cash secureds, I go out to the 25 delta. Oh, my pleasure, my pleasure. It's being recorded. You'll get a recording. All right, well, listen, I ran an hour and 40 minutes over. I really appreciate your time. Most of my trades are bullish. I will tell you that. Yes, they are. Okay, Dennis, one more time on the bid and ask, no problem. On this 310 by 330, let me just delete this. On this 310 by 330, there's a 20-cent difference between the bid and ask. Now, what percentage of that 20 cents is it of the underlying option? So let's take the midpoint and say that the option is priced at 320 at the midpoint. So it's 20 divided by 320. And right here, we're looking at 6%. So that's a terrific bid-ask evaluation. And that tells us that right now, that strike is crossing nice volume. Because options makers love to give you a huge width, because that's where they make their money, between the bid and the ask. Who makes the money from those positions? It's the options makers. I mean, if you have to buy at 330 when the stock is actually when the underlying option is actually trading at the midpoint, they make up the difference. So you don't want to trade when there's a huge difference here between the bid and the ask. This happens to be very advantageous, because that 20 cents is only 6% of the cost of the option itself. So if you look at the midpoint and you take the trade at 320 right here, you got yourself a nice trade. And you can be sure this is a liquid position, or else they would never give you this kind of spread. They're dying to screw you on every trade they can. So when they're stuck with giving you a narrow spread, it's because they're forced to by a lot of volume. So listen, everyone, have a really, really great evening. I'll just show you a quick offer if you want this, if you want to come aboard with the service. I mean, I do all the work for you, and I'm telling you, it is not an easy job. It's not really for this, but let me find the right one here. It's right here. The first month is $49 for the yearly at $698, and it comes with a 100% money back guarantee. I mean, if you don't like it in the first 30 days, you just call Rory 786-732-4656 or email at info@rightline trading. One thing I tell you, I'm a diehard proponent of: if you don't want to be aboard with me, I don't want you to stay. I mean, so you have really 30 days to put up $49, or if you want the year, you still can get your money back if you don't like the trades I send you. So that's just a quickie on the offer. So listen, everyone, I hope you look. No, my pleasure, Dennis. So I hope you learned a lot. I'm going to do these periodically. There's a lot more information I can give you, and I just wish you all, really great luck. Careful with your trading. Evaluate your risk to reward. Take your time, and I'm telling you, you can trade profitably, because I do, and I've had a wonderful month, despite the fact that the market is, giving me a little bit of a knock upside the head in the last couple of weeks. I've given back proportionally very little in terms of what I've made. So again, have a great evening, everyone, and I really appreciate your time. Take care, everybody.